And now we proceed to the direct method formula. No? It is under the operating activities. The first one, cash received from the customers. It dictates here that the amount of sales revenue comes from the sales, which is the goods, products, and even services, is equal to the cash received from customers. For example, you or me as a seller selling one piece of cupcake that I sell or you sell is equal to the amount of cash that you receive. It means the amount of cupcake that you sell equals the amount of cash that you're being received from the return. But in the world of business from now, most of the companies make sales on cash as well as on account because people can rarely find a company that sells goods on account that can calculate the cash received from the customers during the period by using three figures. These are the net sales, beginning balance of accounts receivable, and ending balance of accounts receivable. So we have here the two classifications of accounts receivable here. We have the increase during the period and decrease during the period. The first one, if accounts receivable increase during the period, it says here that if accounts receivable at the end of the year are more than at the beginning of the year, the reasons why the accounts receivable at the end of the year are more than the beginning of the year, it's because the company's credit sales, which is are purchase made by customers for which payment is delayed. So it means that if the payment of such customers on their purchases are being delayed, also the accounts receivable should be delayed. These purchases are made on account, not literally cash. The second one, if accounts receivable decrease during the period. If accounts receivable at the end of the year are less than at the beginning of the year, or should I say a decrease in accounts receivable, it means that the company's collections from customers are more than credit sales, which is the cash received from the customers is equals to the net sales plus the decrease in accounts receivable. It's the opposite on the first one, which is here the sales of such customers are made on cash, while the first one are the sales which made on account. And also the payments of such customers on their purchases are not being delayed, so that the accounts receivable at the end of the year are being lessened than the beginning of the year. So we have here some example. The ABC company sells goods on account. The income statement for the year 2013 shows net sales of $177,000. The accounts receivable at the beginning and at the end of the year 2013 were $25,000 and $35,000 respectively. Calculate total cash that ABC company collected from its customer during the year 2013. So we have here some solution. The cash received from the customers is equals to the net sales minus the increase in accounts receivable. So why is it increase in accounts receivable? At the ending period of the year in the accounts receivable is greater than the beginning period of the accounts receivable. The amount of the ending period, which is $35,000, more than the beginning period, which is the $25,000. So we should subtract the ending period of the accounts receivable to the beginning of the accounts receivable period. So 35 minus $35,000 minus $25,000 is equals to the $10,000, which is the difference of the increase in accounts receivable. And now we should calculate the net sales minus the increase in accounts receivable. So $177,000 minus the $10,000 is equals to $167,000. The next is interest and dividend received. Interest and dividend income is reported in the income statement on accrual basis, which is accrual basis when the revenue is recognized as it's earned and the expenses are recognized as they are incurred. But here we need to convert it into a cash basis, which is cash basis recognized as when the cash is received, and expenses recognized as when the cash is paid out, for the purpose of statement of cash flows. The above concept developed for converting accrual basis sales revenue to the cash basis sales revenue can also be used to convert interest and dividend income from accrual basis to cash basis. The accrual based interest or dividend revenues figure is taken from the income statement and decreased by any increase in interest or dividend receivable during the year and increased by any decrease in interest or dividend receivable during a year. But remember that the amounts of interest and dividend received are just added together. Now we have here some example. The income statement of ABC Company for the year 2013 shows an interest revenue of $5,000 and a dividend revenue of $3,200. The interest receivable at the beginning and at the end of the year 2013 was $1,000 and $1,200 respectively. The dividend income was received in cash and there was no dividend receivable at the beginning and at the end of the year. Calculate the total amount of cash that ABC Company received during the year 2013 from interest and dividend. So we have here the solution of the cash received from the interest and dividend. Interest revenue minus the increase in interest receivable plus the dividend revenue. So the interest revenue, which is $5,000 minus the increase in interest receivable, which is $200. 1,200 minus the $1,000, which is the ending and beginning period of the accounts receivable, is equals to $200 plus the dividend revenue, which is 3,200. So there is no dividend receivable at the beginning and at the end of the year, so that the dividend revenue is equal to the cash received from the dividend. So $5,000 minus $200,000 plus the $3,200 is equals to the $8,000, which is the interest and the dividend received. So first we have here the cash paid to suppliers of inventory. So what are inventory? Inventory is defined as the current asset on the balance sheet that refers to all items, goods, or even merchandises. And now it says here that the companies purchase goods for cash as well as on account. The total amount of inventory purchased during the period does not necessarily represent the amount of cash paid to suppliers of inventory. So, a company that purchases inventory on account may make purchases in just one period and pay cash for such purchases in another period. Therefore, we need to calculate cash payments to suppliers for the purchase of inventory. Next is cash paid for operating expenses. The operating expenses shown in the income statement do not necessarily represent the actual cash payments for these expenses during the period. The reason is that they are reported in the income statement on accrual rather than cash basis. In other words, expenses are reported in the period in which benefits is taken from use of goods or services rather than in the period which in the actual cash payment is made to the providers of such goods and services. So it means that these expenses taken from the goods or services are already incurred. But it says is here that rather than in the period in which in the actual cash payment is made to the providers of such goods and services. So it means that these expenses are already incurred but not yet paid, and therefore they are liabilities or liability. In order to convert accrual-based expenses to cash-based expenses, we need to consider two important points. First, the operating expenses that are reported in the income statement usually include one or more non-cash expenses such as depreciation, amortization of intangible assets, and amortization of bond, discount, etc. Second, there is a difference of timing between the recognition of expenses and the payment of cash for those expenses. The following formula or procedure is adopted to convert accrual-based operating expenses to cash paid for operating expenses. So we have here the formulas. The first one is the cash paid to suppliers of merchandise, or we should say the cash paid to suppliers of inventory is equals to the cost of goods sold. The inventory increase, the accounts payable must decrease, and therefore they are in positive. But if the inventory decrease, the accounts payable must increase, and therefore they are in both negative sign. Next, the cash paid for operating expenses, or cash paid for expenses, is equals to the operating expenses minus the non-cash expenses, which is the most example, depreciation and etc. If the prepaid expenses increase, the accrued expense payable be decrease, and therefore they are both positive. But when the prepaid expense decrease, the accrued expenses payable must be increased, and therefore they are both in negative sign. So here some example. The following information has been extracted from the income statement and balance sheet of ABC Company. The cost of goods sold, which is $65,000, and the operating expenses, which is $15,000. On the accounts payable for purchase of inventory on, it shows here that it has the ending period and the beginning period of the year. So the ending period, which is December 31, 2013, is equals to $15,000, and in December 31, 2012, which is the beginning period, $20,000. Next is from the accrued expenses payable on the ending period, $4,000, and in the beginning period, which is $3,800. Next is from the prepaid expenses on the ending period, which is $5,000, and the beginning period, which is $4,500. And lastly, from the inventory on the ending period has $8,000, and in the beginning period, which has $6,500. So here's some solutions. First, we should calculate the cash paid to suppliers of inventory. So the cost of goods sold plus increase in inventory plus decrease in accounts payable. So the cost of goods sold has $65,000 plus the increase in inventory, which has $1,500. So in the increase in inventory, we should calculate the ending period of the year minus the beginning period of the year. So in the ending period of the year, in increase in inventory has $8,000 minus the beginning period of the year that has $6,500, which equals to $1,500. Plus, in the decrease in accounts payable has $5,000. So in the decrease in accounts payable, so we should compute or calculate the beginning period minus the ending period of the year here in the decrease in accounts payable. So in the beginning period, which has $20,000, minus the ending period, which has $15,000, so it is equals to the $5,000. So $65,000 plus $1,500 plus $5,000 is equals to $71,500. And next here we should calculate now the cash paid for operating expenses. So here operating expenses plus the increase in prepaid expenses minus the increase in accrued expenses payable. In the operating expenses, which has $15,000, plus the increase in prepaid expenses, which has $500. So here in the increase in prepaid expenses, we should compute the ending period of the year minus the beginning period of the year here in prepaid expenses. So in the ending period, which has $5,000, minus the beginning period, which has $4,500. So $5,000 minus 4,500 is equals to $500. And next, minus the increase in accrued expenses payable, which has $200. So here in increase in accrued expenses payable, we should also do the same thing. So in the ending period, which has $4,000 minus the beginning period, which has $3,800. So 4,000 minus 3,800 is equals to $200. And now calculate $15,000 plus $500 minus $200 is equals to $15,300. And now for the disclosure in the statement of the cash flow, we should now add the cash paid to suppliers of inventory and the cash paid for operating expenses to get the sum of the cash paid to suppliers and employees. So in the cash paid to suppliers of inventory, which has $71,500, plus the cash paid for operating expenses, which has $15,300, is equals to $86,800, which is the sum of the cash paid to suppliers and employees. So the next one, we have here the interest paid. So the interest paid says here that the formula used for operating expenses can also be used to convert interest expenses to cash paid for interest. Any decrease in interest payable is added to, and any increase in interest payable is deducted from the accrual-based interest expenses. So in the accrual-based interest expenses figure is available from the income statement, and the increase or decrease in interest payable can be found by making an analysis of comparative balance sheet. And take note that accrual-based interest expenses is a form of liability because these expenses are accrued expenses that already incurred but not yet paid, and therefore they are form of liability, so that the interest payable is being deducted from the accrual based interest expenses. So here some solution and example of the cash paid for interest. So the cash paid for interest is equals to the interest expenses if the decrease in interest payable and increase in interest payable. So in the decrease in interest payable should be positive, and in the increase in interest payable should be negative. So in the example, the ABC company's total interest expenses for the year 2013 were $7,800. The interest payable at the end of the year 2013 and 2012 was as follow. So in the interest payable at December 31, 2013 has $1,200, and interest payable at the December 31, 2012 has $1,800. So says here that calculate the cash paid for interest during 2013 first. So the solution here is the cash paid for interest is equals to the interest expenses plus the decrease in interest payable. So why is it decrease in interest payable? So here the interest payable at December 31, 2013 is less than to the interest payable at December 31, 2012. So the interest expenses has $7,800 plus the decrease in interest payable, which is $600. So here in decrease in interest payable, the interest payable on December 31, 2012, which has $1,800 minus the interest payable on December 31, 2013, which is $1,200. So 1,800 minus 1,200 is equals to $600. So let's go back to the main solution. So the interest expenses, which has 7,800, plus the decrease in interest payable, which has $600, is equals to the total of the cash paid for interest is equals to $8,400. Next is the income tax paid. So like the interest and operating expenses, the cash payment for income tax during the year can be calculated by adding a decrease in income tax payable to and deducting an increase in income tax payable from the income tax expenses shown in the income statement. So here we have the formula on how to calculate the income tax paid. So cash paid for income tax is equals to income tax expenses. Then the decrease in income tax payable should be in positive. because we should add the decrease in income tax payable from the income tax expenses, and next is the increase in income tax payable, so that we should deduct the increase in income tax payable from the income tax expenses. So here are some example. So the income tax expenses of ABC Company were $8,700 as per income statement for the year 2013. The income tax payable at the end of the year 2013 and 2012 was as follows. So in the December 31, 2013, which has $1,400, and in the December 31, 2012, which has $1,000. So says here that we should calculate the cash paid for income tax during 2013. So in the solution, cash paid for income tax is equals to the income tax expenses minus the increase in income tax payable. So why should increase in income tax payable? So says here that in the December 31, 2013, which is the ending period of the year, is greater than December 31, 2012, which is the beginning period of the year. So in the income tax expenses, which has $8,700 minus to the increase in income taxes payable. So in the income tax payable on December 31, 2013 should be minus to the income tax payable on December 31, 2012. So $1,400 minus $1,000 is equals to the total of the increase in income tax payable of $400. So we should calculate the now we should calculate the total of the cash paid for income tax. So $8,700 minus the $400, so it is equals to $8,300. So now the ABC company's operating cash receipts and disbursement have been calculated above. We can now prepare a complete operating activity section on the company under the direct method. So here we have the completed calculations of the cash flow from the operating activities. So we have here the cash received from the customers, which has $167,000 plus the interest and dividends received, which has $8,000, is equals to the total of $175,000, and the cash paid to suppliers and employees, which has $86,800, then add from the interest paid, which has total of $8,400, and also add to the income taxes paid, which has $83. So it has a total of $103,500. So we should deduct now here the cash receipts and the cash paid So the total of the cash receipt here is 1,007. So we have here now the complete cash flows from the operating activities under the direct method. So we have here in the cash receipt section. So the cash received from the customer has a total of $167,000 plus the interest and dividends received, which has the total of $8,000. So equals to the total of $175,000. And for the cash payment section, we have here the total of the cash paid to suppliers and employees, which has $86,800 plus the interest paid, which has $8,400, and from the income tax payable, which has $8,300. So we got the total of $103,500. So we should got the difference from the cash receipt minus the cash payments in the operating activities. So $175,000 minus $103,500. So we got the total of the net cash provided by the operating activities, $71,500.